Today, we're diving into the essential process of recording financial transactions, a fundamental skill for understanding any business. This process is key to truly understanding a company's financial health and operational activities effectively. Let's explore the four core financial statements, which are the backbone of financial reporting. Each statement offers a unique perspective, telling a distinct part of a company's complete financial story. First, we have the income statement, which reveals a company's profitability over a period. Next, the balance sheet provides a snapshot of assets, liabilities, and equity at a specific point. Then, the cash flow statement tracks how cash moves in and out of the business. Finally, the statement of changes in equity shows how owners' equity has changed over time. Let's begin by focusing on the income statement, a vital tool for assessing financial performance. Also known as the profit and loss statement, it summarizes revenues, expenses, and profits over a specific period, revealing a company's profitability. Now, let's break down the typical structure of an income statement, step by step. We'll track the journey from top-line revenue all the way down to the final net income. We start with net revenue, representing the total income from sales after any deductions. This is the total income a company generates from its sales, after accounting for returns or discounts. Next, we subtract the cost of goods sold, which are the direct costs of producing items sold. These are the direct expenses tied to creating the products or services that the company sells. This brings us to gross profit, calculated by subtracting cost of goods sold from net revenue. It shows how much profit is made from sales before any operating expenses are considered. Then we arrive at operating income, which is the profit after deducting all operating expenses. This figure reveals the profit generated from the company's core business operations, excluding taxes and interest. Finally, we reach net income, which is the ultimate profit after all expenses and taxes. This is the bottom line, representing the company's total profit available to shareholders. Let's move on to the balance sheet, another fundamental financial statement to understand. Also known as the statement of financial position, it's a snapshot of a company's assets, liabilities, and equity at a specific moment. Now, let's break down the key components of the balance sheet and their relationships. These components are all interconnected by the fundamental accounting equation: assets equal liabilities plus equity. First, we have assets, which represent everything a company owns that has economic value. These are the resources controlled by the company from which future economic benefits are expected. Assets are categorized as either current, convertible to cash within a year, or non-current, long-term assets. Next, we look at liabilities, which are what a company owes to external parties. These are the company's financial obligations or debts that must be settled in the future. Liabilities can be current, due within a year, or non-current, with longer repayment terms. Finally, we have equity, representing the owner's residual interest in the company's assets. This is what's left for the owners after all liabilities have been paid off. Equity typically includes common stock and retained earnings, reflecting the owner's investment and accumulated profits. Now, let's explore the cash flow statement, a crucial financial document that reveals a company's cash movements. It shows cash inflows and outflows over time, detailing how cash is generated and used across operating, investing, and financing activities. Let's break down the different types of cash flow activities that are reported in this important statement. This section helps us understand exactly where a company's cash originates from and where it is being spent. First, we have operating activities, which represent the cash flows from a company's primary business functions. These are the essential, day-to-day transactions that drive the core of the company's operations. This includes cash from sales, payments for expenses, and the cash used for taxes. Next, investing activities show cash flows related to acquiring or selling long-term assets for future growth. This category covers cash used to purchase or received from selling various types of assets. Think about buying or selling property, equipment, or even other long-term investments. Finally, financing activities deal with how a company obtains and repays capital from investors and creditors. This involves transactions related to either acquiring new funds or paying back existing funding sources. Examples include taking out loans, issuing or buying back shares, and paying dividends to shareholders. Now, let's turn our attention to the Statement of Changes in Equity, which tracks shareholder value. This statement provides a detailed summary of how a company's equity changes due to profits, losses, dividends, and share capital. Let's walk through the flow of how equity changes are presented in this important financial statement. This flow helps us meticulously track how the overall value for shareholders evolves over time. We begin with the opening balance, representing the total equity value at the very start of the period. This is simply the initial amount of equity that the company held when the period began. Next, net income or loss from the income statement directly impacts the retained earnings component of equity. Whether the company makes a profit or a loss, it directly adjusts the retained earnings balance. Dividends paid are the cash distributions made to shareholders, which reduce the company's equity. These are the amounts of money that the company gives back to its owners or shareholders. Share transactions include the issuance of new shares or the repurchase of existing company shares. This involves activities like selling new shares to investors or buying back shares from the market. Finally, the closing balance represents the total equity value after all these adjustments for the period. This is the updated and final equity value that the company holds at the end of the reporting period. Let's summarize the key points and essential takeaways from our discussion on financial statements. Here are the most important concepts and principles that you should definitely remember from this lesson. Remember, financial statements offer a complete and holistic view of a company's overall financial health. The income statement is crucial for understanding a company's profitability over a specific accounting period. The balance sheet gives us a snapshot of assets, liabilities, and equity at one specific point in time. The cash flow statement meticulously tracks cash movements across operations, investing, and financing activities. And the statement of changes in equity shows exactly how shareholder value evolves over time. Together, these statements empower stakeholders with the insights needed for informed and strategic decision-making.